want to bring on today's guest, Samantha LaDuc. Samantha is the founder of LaDuc Capital, coming to us from the Boston area. Samantha, a pleasure to see you. How are you?
I'm doing well. Thank you so much, David.
No, I appreciate it. And I feel like always wish we have more time because there's so much to think about in these current market conditions. I mentioned in the market recap AMD, potentially bouncing off support. The last time you were on our show, we talked about semiconductors. Can you give us an update on what you're seeing in that key sort of bellwether space?
Well, first, I got to go backwards before we can go forwards. We obviously have kind of rolled over in August and September. That lovely seasonality always helps. But so does internal breadth breaking down, perfectly timed with a very large treasury issuance on July 31st. So we have definitely, I think it's what, 6 to 7% basically in SPY. Since that peak. But what's interesting is under the surface, as you just mentioned, breadth. And what I follow, which is net buying, selling indicators, part of the breadth analysis, they're still very, very weak sauce. So I kind of go back and take a look at that expansion of small caps. They're still in trouble. They're really flat on the year if it wasn't for the Magnificent Seven, of which NVIDIA is a large player, not only in market cap, but also sentiment with the AI boom. It's also up 1,000% in the past 10 years. I mean, even Apple's not even, up 400%. So I mean, there's definitely this incredible excitement over semiconductors and in particular AI since May that very much in large part kind of drove this euphoric bullish move. But since that treasury issuance, which is very, very, very much a supply issue, treasury dumped a whole bunch of bonds onto the market. And interest rates and dollar have been rising since then. And dollar and yields will trump any kind of, sentiment, really. The narrative will start to turn and then selling will start to pick up. So that's really what happened. And semis are just part and parcel of one very, very large sector that bears watching because it has been so strong. So as dollar has moved up 5%, off the lows, again, in the last 2 months, and yields, the velocity and also the volatility that has come into the market because we've had such a strong steepening in the 2 and 10 yield curve, but across the curve, that's actually now a headwind for equities. So semis are no different. They're not immune. We might be having a very strong technical bounce. We stabilized yesterday into today at a very key level. I had actually 42.40 and it did tag. But we have a reason for why we kind of stabilized. One, market makers and optionality. There's some very large gamma and hedging, put hedging that basically is monetized. But we also had GDP revision this morning and jobless claims. Jobless claims continue to fall, which is just, case of strong employment backdrop. That is actually helping in wage inflation stay very firm and delay recession. But consumption actually fell and GDP actually was revised lower. So we bounced, or I should say, dollar and yields softened on the prospect of slowing economic growth. So the question really is that really a bullish backdrop for equities, or are equities potentially pricing in maybe more of this potential Fed kind of walking back some of its cuts that it pulled out of the market last week? So I very much look at the macro, the micro, the intermarket breadth, and in particular, this strength of the semi-rotation has been unparalleled, right? And case in point, NVIDIA. But as you can see from that chart, there is a formation I've been tracking. And last time I was on this show with you, I said, I'm going to just take a big look at this in a few months and see if we've actually softened. And we have started to soften and roll over in this intermarket towel.
It's interesting when we were talking about it, you covered so many things there, Samantha. It was really, really well done. When you look at the 10-year yield, right, we've spiked, and you pointed out the steepening of the yield curve, which is sort of a different look now in the last month or two. We've seen the 2 to 10-year spread starting to narrow a little bit, starting to come up here. When you see 10-year yields getting up to 4.6, 4.7%, do you have a terminal rate in mind that you think the 10-year could get to this point and then something important happens? Or how do you think about how far we've come, how far rates have come out, and how that impacts sort of leadership trends that we've been observing?
this is the point, right? So we
Yeah.
get to a point where they kind of start to cry uncle. So back in October, we had a lot of central bank intervention that came in October of 2022, and that actually helped bonds from falling further and obviously helped equities get bid. But fast forward, right? We're kind of really, really working on that same level of yield that we had in the 10-year at 4.33. We're actually above it. And I had written last year that this particular 2023 wouldn't surprise me because, you know, I've been a big bond bear on your show every single time I talk about this. But this has been one of those deals where we are still at risk of moving higher. And I had said last year that if we hit 4.7% in the 10-year, it'd be about 85 in TLT. So we're closely approaching that. And that is where I think we get a really strong impulse in volatility. So we've come so close yesterday and today, backed off a little bit on, again, slowing economic data prints. But I think once we hit that 4.7, it's not only a kind of an emerging market panic trigger, but it really does upset the apple cart for bonds and bond proxies, and specifically FX. So currency will start to become more fragile. And this inflation that we have, which is very, very sticky, is very much weakening to most local currencies, which is giving the strength, the seeming strength in the dollar. I actually think we have some more to go in the dollar, and that yield price target of 4.7 will start to help semis and mega cap tech in general roll over. So that's actually why I wanted to bring up that second chart, which is it hasn't broken yet, but that growth to value rotation trigger, which, as you can kind of see, has been sideways since June. So we really had this bottom in this ratio, which is literally growth to value, in January. We had the nice January effect. We got supported extremely well in the March 12th, Fed, Treasury, White House, bank backstop or bailout. Then we had the AI extravaganza. And then June 1st is actually when breadth started to expand again. We had a beautiful value rotation. And I deemed that stalking value rotation. And we had a beautiful advance in a lot of value plays relative to growth. And they started to basically kind of compete, which one's going to outperform. So now we're on a critical level. I mean, so the monthly of that SMH to SPY ratio is forming a head and shoulders, which is a reversal pattern. This growth to value rotation is on a daily time frame, and that very much is on support until it isn't. And I think this is where we'll have more selling of the, the New York FANG, the Magnificent Seven, whatever you want to call them, the mega cap tech plays that have been in distribution, like you said, but they haven't really fallen like, for example, bonds. So I think there's a lot of safety still in that concentration risk of mega cap tech, and I think we're going to see some volatility come into that space for the rest of the year.
It's some really good points in there, Samantha, particularly with growth versus value. It's so interesting. I think it's surprising in some ways that they're so evenly matched here in the last couple months, but I guess it makes sense. If we do get that breakdown in growth and value starts to outperform, there's sort of a couple different buckets of value, right? We have sort of the cyclical energy, industrial type of value. Then we've got the really defensive kind of utilities, REITs kind of value. Where do you see opportunities if the growth stocks start to come down? What rotates into a position of leadership?
So this is tough because we've had energy outperform now for 3 years. So since it came up off the bottom and oil as an inflation hedge, right? And inflation has absolutely stayed sticky. We really have had outperformance in energy, which has been a baseline bet, but it's been 3 years. Now, energy outperforming is actually a bit of a headwind, not only because of the underlying, strength in crude and other oil complex is just a headwind for margin compression and cost of living and everything that's related to, consumers and corporations. So that's one thing. It has definitely been a place where a lot of folks have hung out and been really well rewarded by not having to worry because it has been so strong as a sector. So I don't think it's going to go away, but it does worry me that there has been so much concentration in that space. And of course, at a point it becomes a bigger headwind as a sector rotation leader. So then you go to kind of, okay, what about anything tied to China? Not so much. So there are industrials and others that, as long as they're tied to commodities, because I'm a commodity bull in general, not just uranium, which has had a phenomenal, ascent. Also part of that things over paper mantra since summer of 2020. But I'm talking wider, not copper, because that's actually an economic slowdown tell, and China's buying less, and they're the largest marginal buyer. So there are, in general, things that are inflationary that are better bets, that are obviously core to some companies' assets. I'm interested in that, and their ability with earning interest on their cash or cash equivalents, like Exxon's doing extremely well, for example, right? And then there are a lot of zombies that are going to go bye-bye. So the zombies in that small cap space. So if you look at the market to date, here we are approaching October, we might have the S&P now pushing very, firmly higher, but the stuff underneath the surface is a mess. So we're actually down on the year for the Russell 1000. We're down 7%. We're flat as it relates to the Russell 2000. So mega cap tech or the Magnificent Seven have definitely been carrying the mantle, and that's a big burden. That's what I'm worried about, is actually that other ratio chart that we talked about, which is Russell IWM to SPY on a monthly basis, has broken down to 2008 lows. That's not actually bullish either. It shows that there's a lot of risk actually in these smaller cap plays as they have to refinance their debt next year, as they are dealing with a slowing economy. So I think actually we have very few pockets that are safe as it relates to value. So yeah, energy is going to be fine. It's going to go down less, but ultimately there are going to be material stocks and some that are tied to real estate, just because it's holding its value, it's not falling. But as we start to get through the year in 2024, even those will be challenged as we pull forward a recession. But right now, I still think we're still paid to wait, and then very selective value plays that are not going anywhere, that have very strong balance sheets, not the zombies, not the mid cap tech. And I think mega cap is going to be pressured.
Rocks over paper. I love that comment. I love that thing to keep in mind for sure. And you've certainly seen some of those movements that you referred to. Samantha, thanks so much for putting that all into context, hitting on a number of different key themes here. I think we have a lot to digest, and certainly a lot to prepare for here going into the fourth quarter. Be well, stay safe there in Boston. We'll talk to you again soon, Samantha.
Thank you so much.
That's Samantha LaDuc. Samantha's the founder of LaDuc Capital, coming to us from the greater Boston area. And I love the comments about, interest rates. When you think about how much the rates have gone up, to summarize one of the comments that I think Samantha made very well is, don't confuse the top of the page with resistance. When I look at a 1-year chart of the 10-year, it's gone up a ton. Now, at some point, that starts to revert, and you get a bit of a mean reversion. I think that could be something that she was talking about around the 4.7 level for the 10-year. A number of key levels to pay attention to. Can't disagree with the importance of semiconductors and a rotation away from growth. I think we're still beginning that trend as well. Great take there by Samantha LaDuc.